So here we go. We're going to share the slides. So we're here today to talk about the controlled foreign company rules, which are now introduced into Gibraltar legislation. And we're going to talk a little bit about why we've done this first. Well, as with everything, the global multilateral anti-avoidance project, which is known as BEPS, the Base Erosion and Profit Shifting Project, has driven this provision to be rolled out across the European Union. It is part of our avoiding being included on the EU's list of non-cooperative jurisdictions. That generally that we implement things partly because they're the right thing to do, but also the consequences of non-implementation would be that we may end up on the non-cooperative list. The EU has a separate non-cooperative list from the OECD and recently put Cayman on there, which created some consternation. And this provision is also mandated on us by the EU Anti-Tax Avoidance Directive, which the deadline for implementation of this was the 31st December last 2018, so going into 2019. It's 18 months old now. We implemented it in early 2019, and it is contained in Schedule 4, Part 4 of our Income Tax Act, and it is applicable to all financial years ending after 1st January 2019. So all tax returns for financial years which have ended after the 1st of January 2019 should have included provision for any controlled foreign companies that are relevant to the returning entity. So it's in place now. It's relevant to tax returns that are being filled in today. It is something that accountants need to be fully aware of and will drive information gathering to subsidiaries, from subsidiaries, which, whilst the information may have been there, it will need to be done in a more formal way. Subsidiaries will need to prepare accounts if they're in jurisdictions that aren't preparing accounts. Then you will start to see that information quality will be driven up as a result of this, because the directors of the Gibraltar parent won't be able to do their job in return to their tax return, in relation to their tax return, if they don't insist on subsidiaries preparing adequate information reports to them. So let's just dive straight in. It's a relatively simple provision. First of all, any subsidiary of a Gibraltar entity needs to be classified as to whether it is or is not a controlled foreign company. So what does that mean? What is the definition of a controlled foreign company? So it is an entity, any entity or permanent establishment, which is the following test. So you need to remember that this is not just about subsidiary entities. It is also about permanent establishments of the parent. And so in order to understand what a permanent establishment is, you need to understand what the OECD model definition of a permanent establishment is, and you will find that in the Gibraltar UK Treaty. It is not just a place of business, it also includes agency, and you need to understand the definition of an agency permanent establishment. I'm happy to discuss that at length with anybody who needs to understand that, and I'm happy to be available for anybody who wants to give me a call and help them through these novel concepts that Gibraltar law has not really had, though they have been buried away in some of the EU directive implementations. But the concept of permanent establishment and agency permanent establishment especially is something that we wouldn't really have considered and would not have been relevant to our law, though obviously it would be relevant in different jurisdictions. So it needs to be an entity, so a subsidiary or a permanent establishment of the Gibraltar entity. And it has to be a non-Gibraltar resident. So if you remember from the last session that we did, the Gibraltar residence test for a company is that the management and control, the central management and control, that is the top level strategic thinking as is done by the directors, is or is not located in Gibraltar or carried out by somebody, an individual who is ordinarily resident in Gibraltar. So you could have a foreign entity with its directors in Gibraltar. That may trigger some registration requirements. We'll talk about that another time. But its directors being located in Gibraltar would make it ordinarily resident in Gibraltar. So in that case, a Gibraltar resident company would not qualify as a controlled foreign company. So it needs to be an entity or a permanent establishment, and it needs to be not Gibraltar resident. Also important to remember that not Gibraltar resident is not necessarily a test of incorporation. A Gibraltar company could be not Gibraltar resident if its directors, I think the example I used were in Marseille, Sicily and Athens. That company is not Gibraltar resident, and even though it's registered in Gibraltar. Mere registration is not the test of residence in Gibraltar. So the relevant entity that we're talking about, we're analysing whether it's a controlled foreign company. It needs to be an entity or a permanent establishment. It needs to be non-Gibraltar resident, and it needs to be held either 50% voting rights or 50% capital or 50% right to receive profits by a Gibraltar taxpayer, where taxpayer is defined, as we said in the last session, as an ordinarily resident company with assessable income. So, and you aggregate, where you have associated enterprises, you aggregate their holding, so you can't just break the holding up amongst several different sister companies. You aggregate the holdings together to work out the 50% hurdle. So that's the first test. That's, is it foreign? Is it controlled? And then we need to work out whether it qualifies as the kind of company that we're interested in here. And that is that the entity or permanent establishment pays less than 50% of the tax which would be paid by the taxpayer if the income in question belonged to the taxpayer. So obviously, we have different tax treatments for different kinds of income in Gibraltar. So it's very relevant there. This is not just a, does this company pay less than 5%, which is obviously our headline rate is 10%. I would read this legislation as saying that it's 50% of the tax which would be paid, not the headline rate. So if the company, the Gibraltar company, would not pay tax on the relevant income, if it's all accrued and derived outside Gibraltar and it isn't the kind of income which we tax based on registration, then a company which meets all the other tests would not be relevant. It would not be a controlled foreign company for the purposes of this provision. And that's quite interesting, but it does mean that you need to understand the business of your subsidiary. As an accountant, you need to understand the business of your subsidiary, maybe in a way that, or maybe to a depth that you didn't necessarily need to know before, especially if it was in a very low tax jurisdiction or a zero tax jurisdiction. So I think that's quite clear. It's quite easy to understand. Is it an entity or permanent establishment? Is it Gibraltar resident? Does the Gibraltar parent own more than 50% of it in any of those three ways? And finally, does it pay less than 50% of the tax which would be paid by the taxpayer if the income sat with the taxpayer? So we've identified that we've got a controlled foreign company and anything else. Let's think of a situation which would be relevant. We've got a Gibraltar parent, a British Virgin Islands subsidiary. The British Virgin Islands subsidiary holds intercompany interest receivables of £5 million a year interest. So that's well within scope if it was in the hands of the Gibraltar parent for tax. And what do we do with it now that we've identified? Oh, and the BVI company's directors are not in Gibraltar. So what do we do with it once we've identified whether or not it is a CFC? So the income of the CFC, or some of the income of the CFC, is deemed to be the income of the parent. That's the basic principle. What they do is they look through the existence of the CFC and attribute the income to the parent as if it was the income of the parent. There are some measures around what income you do or do not attribute, but that's the general principle. So, there is a first hurdle, or sorry, there are 3 hurdles for us to attribute income to the parent. And the first is that the income must be non-distributed. So it must be stored up in the controlled foreign company. At the end of the year, if the income is not distributed, then it may well be within scope for the CFC charge. So if the company distributes, if the controlled foreign company distributes its income to its parent, it is outside of scope of the CFC. And that gives away what the aim of the CFC provision is. They've been around for a long time, CFC provisions. They were introduced, first of all, by the Americans in the 50s. UK followed suit in the 60s, and they are really common across the whole of the world. This is not something novel. This is long-standing. But this non-distributed income rule is important because it tells us what the intentions of the charge is. The aim of the charge is to either tax income hidden in low tax jurisdictions, or to push the income into a place where the parent jurisdiction can tax if it chooses to. There is no mandated order to tax income which is distributed up from a low tax subsidiary. It is only if the low tax subsidiary is used to shelter that income from tax. So the act of distributing puts that income into the space where Gibraltar can tax it. Gibraltar chooses not to tax it. That is not a result against the aims of the CFC rules. That is exactly the aim that the CFC rules have in mind, which is to put the income of the controlled foreign company into the tax area of the parent jurisdiction. And then the parent jurisdiction applies its normal rules. So several other jurisdictions would not tax, and because they would provide a participation exemption, they would exempt whether 100% holdings are, though there may well be some anti-avoidance regime. But that's the point. Controlled foreign company rules are designed to push the income into the hands of the parent jurisdiction, and the parent jurisdiction applies its rules as expected. So that's number 1. The second hurdle for whether we attribute the income of the CFC to the parent is that the income must arise from non-genuine arrangements. And thirdly, the non-genuine arrangements must have been put in place for the essential purpose of obtaining a tax advantage. So this is a 3-part test. This is really quite difficult to get over these 3 parts. First of all, the income must be non-distributed at the end of the year. Secondly, it must arise from non-genuine arrangements, and we'll talk about what the definition of a non-genuine arrangement is. And then, even if it falls within the definition of a non-genuine arrangement, we must have the intention of the essential purpose of obtaining a tax advantage. And those of you that have attended my DAC 6 lectures will notice the difference here between the DAC 6 main benefit test, which looks at the facts as they are, the results of the arrangements, whereas this test, the essential purpose test, looks at the intention of the parties. That's a very different test. And so that means that when you're putting in place something which you're worried may become a controlled foreign company, or may be deemed to be a controlled foreign company, you need to understand what the essential purpose of the arrangement was. It should be recorded properly, minutes, and maybe an opinion. You should be building the paper trail, because a paper trail that doesn't exist is a paper trail that is inadequate. So you should be recording your decisions. The fiduciaries amongst you should be recording your decisions and explaining your thought processes at every turn. That's just good practice all round. So let's look at what non-distributed means. Well, non-distributed means exactly what it says. It's income which has not been distributed to its shareholders or to those who are entitled to an equity profit share. So I'll give you 3 examples. I've got 3 examples here of income which are not distributions. So flows of money which are not distributions. Interest payments to a parent are not a distribution. That is an expense. It comes out before the calculation of profit. Capital repayments on a loan equally are merely just a repayment of a debt. They are not a distribution. And finally, a profit participation loan payment. This is important. This is technical, but a profit participation loan payment is not an equity profit share, but a participation payment, a profit participation payment, as opposed to a profit participation loan payment, is a profit share if the principal on the loan is not repayable in its own right. So this is what the commissioner looks for when he sees the difference between a profit participation loan and a profit participation purchase. A profit participation loan is essentially a loan with a fancy way of calculating the interest or return. A profit participation purchase is buying future profits from the company. One gets its capital back, and that debt survives whether or not there is a profit. The capital is still repayable even if there's no profit. One has no right to reclaim its capital even if there is no profit. It's an important distinction. And obviously a profit participation purchase counts as a distribution for these purposes. So we've worked out that our payment is a distribution, or is non-distributed. Now we need to work out whether the arrangement that we're entering into is a non-genuine arrangement. And I do apologize for the technical language in this first bullet point. But hopefully the second bullet point will translate it into normal English. So a non-genuine arrangement is any arrangement whereby the controlled foreign company, that's the subsidiary, the foreign subsidiary, would not own the assets or bear the risk which generate the income if it were not controlled by a company, and that company is the company where the significant people functions which are relevant to those assets or risks are carried out. So the phrase significant people functions is a phrase that you guys will see regularly if you follow international tax. And that essentially means where the people do the work. So if a company has the significant people functions to give rise to income, that is where the work occurs that relates to the asset or the risk. So let's go back to our example of a BVI company underneath a Gibraltar company. And the BVI company does not carry out any of the negotiations to generate the asset, which is the loan. It does not do a risk assessment. It does not have a credit committee or any sort of directors that take an active role in the loan negotiations or in any way towards the generation of the asset. That all occurs in the parent, the Gibraltar parent, or maybe even occurred before the BVI company was even incorporated. Maybe the loan was negotiated, entered into, and then assigned or novated to the BVI subsidiary. That is a non-genuine arrangement for the purposes of the CFC rules. So to translate our first bullet point into plain English, if the CFC is under the control of another company and that other company does all the work that leads to the creation of the asset which generates the income, then that arrangement is non-genuine. And you can see, that's clear, isn't it? Gibco does all the work, it negotiates it, and then it goes, oh, okay, we'll shove it into the BVI subsidiary, and that means that, oh, great, we don't pay any tax. That's clearly non-genuine. if that's the full story. So it's also important to know that we have a DeMinimis rule, which is good to have, in the sense that small amounts will not carry a burden of extra effort on the part of, and cost on the part of, parents. So the CFC rules do not apply to a CFC which has less than 750,000 euros in total profit, and which also has no more than 75,000 euros profit in non-trading income. So for your purposes, the most important test there is the 75,000 threshold for non-trading income. The kind of things that you're going to see, I think, is mostly interest, is mostly royalties, is mostly passive income. I think given our territorial scope of taxation, the only things which could conceptually fall into a CFC position are interest, royalties, and the third one, which is the non-trading income from movable property. Those provisions that are taxable by virtue of registration, not by residence or territoriality. Any other company which has trading income in Gibraltar which isn't paying its tax is already in breach of our rules and should be filing a tax return and probably registering for Part 12 or Part 14. So finally, and DeMinimis rule, if the CFC has accounting profits which amount to no more than 10% of its operating costs, then that will also be beyond the scope of the CFC rules. Again, I don't think you're going to see that. I think that basically the only kind of company that has accounting profits of no more than 10% of its operating costs, if it's making money properly, is probably a supermarket. And we're not going to see that kind of thing in a CFC under a Gibraltar entity. It just wouldn't create any benefit. That's aimed at real operating companies, or operating companies that have bricks and mortar businesses. So calculating the attributable income. So all income which is attributable to significant people functions carried out by the controlling entity is attributable to the parent. So in our example of parent BVI Co, all of the income from the loan that the parent has negotiated would be attributable to the significant people functions carried out by the controlling entity. And that is calculated in proportion to the participation of the controlling entity. So if the controlling entity only owns 10% of the CFC, it will be charged tax on 10%. And it includes the income in the tax period. You include the income in the tax period of the controlling entity in which the tax year of the CFC ends. So if your tax year ends on the 30th of June, to be topical, and the CFC's tax period ended on the 31st of December, you include it in the following tax return for your parent. There is a deduction to resolve the position where a distribution is made in a later year. Deduction is given if the controlling entity later receives a dividend, and that dividend is included in the assessable income of the recipient. But it does feel to me like, as company-to-company dividends are not taxable, no credit will ever be given. And I think we need to see how the Commissioner is going to look at that, and how he would interpret the word assessable income in that particular position, because it would seem to rather defeat the object of the provision if it's actually physically impossible to ever get the relevant credit. But I think that we will need to see what his position is. It's not clear to me. Now, I'm sure somebody probably has heard. And a deduction will be given for any element of disposal consideration which has previously been taxed, and a deduction is allowed for any liability which the permanent establishment or the entity, the CFC, has in its state of residence. So let's say the company pays 5% in Malta, the CFC pays 5% in Malta, actually pays 5% in Malta, and it has a 10% liability in Gibraltar, it will get a credit or have a deduction for the 5%. So how do we show this? What do we do with our tax return? Well, it's not exactly clear, but I think the logic of it is sensible. There is no special box or entry on the CT1. The CT1 hasn't been changed as a result of any of these 4 provisions that we're talking about. And my feeling and the feeling of the people that I've spoken to is that what you do is you just introduce the income into the tax computation before you file the return. It's really important to remember for the fiduciaries in the room, for anybody who's not the accountant an accountant in the room, this provision is not like our old anti-avoidance rules where the commissioner or the tax authorities had to make an investigation, find that an error had been made, and add it into the assessment. The parent company is obliged to include CFC income in its return when it files a return, which means that the parent must know all of what's going on underneath it in its subsidiaries. And accounts need to be prepared below, otherwise the parents of the subsidiaries, parents of the directors of the parent cannot know sufficient information to file their CT1 correctly. And then finally, you pay the tax. So a couple of examples, and I think I've alluded to this as we've gone through the session. A zero tax subsidiary is incorporated to make a specific loan previously negotiated by the GIB parent. Classic example. And intellectual property developed by the Gibraltar parent is contributed to a subsidiary in a zero tax jurisdiction. We could also talk about leasing non-trade leasing of movable property, but they are, because of the nature of our taxation system, I do believe they are the 3 situations in which you're going to see it. If people think there is any other situation in which the CFC rules would apply, I suppose where we have a licensed entity, maybe, or a licensable activity, maybe that because that's deemed to accrue and derive in Gibraltar, maybe some other situations, imputed income or other deeming provisions, possibly maybe something around partnerships. But you could, I'm happy to talk those through with you and to work it through conceptually. I haven't completely exhausted the entire Tax Act yet on possible scenarios, but I'm happy to assist anybody who wants to have a chat. I won't necessarily charge you straight off. Okay, so that is the end of the slides. 30 minutes, I think we did okay. So that's me, by the way. Oh, and by the way, in the last 2 days, I got my results from my Chartered Institute of Tax exams. So that's the ADIT at the end of my name is new. So I'm quite pleased about that. And we're going to stop sharing now. Does anybody have any questions? Either on the chat or the Q&A bubble, feel free, or if you want to put your hand up. Feel free. Everybody understood perfectly. That's good. There's got to be one question. Okay, there isn't. Right, well, if that's the case, thank you very much for your time, everybody. And thank you for attending. I think the next one we're doing is interest expense cap. And then and that won't be next week, it will be the week after. And the fourth one will be the hybrid mismatch rules, which, like I said, are very technical, but it's worth being aware of their existence. So thank you very much for your time. Very nice of you to attend. We sure there's no questions? Okay, cool. Thank you very much for your time, and see you in 2 weeks' time. Marketing will send the slides, and the video will be put up on YouTube in a private link. If anybody, well, nobody's asked any questions, so there shouldn't be any problem. Thank you very much for your time. Goodbye.